Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. Welcome to the i3 podcast. I'm here today with John Pearce, who's the Chief Investment Officer at UniSuper, a $100 billion fund for the university sector. John, welcome to the show.
Pleasure.
So you're pretty well known in Australia, but can you take us a little bit back to where it all started? How did you get interested in investing?
Well, I started off in the back office of Westpac Investment Management, and saying the back office, I would recommend that to any investment professional. I think it's a really good grounding. You learn the nuts and bolts of the business, and I think you also start. You learn a bit of humility as well. And look, I spent pretty much the first 2 decades of my career then moving on into a dealing room environment, which was a pretty exciting place to be for a young guy.
Yeah, I can imagine so. So already from that early days, you were involved in trades and really getting a look into the nuts and bolts of transactions?
Yeah, and it was obviously a very different environment because we didn't have the benefit of all the electronics, etc. So a lot of stuff was done in open outcry and yelling and screaming, and in the middle of smoke hazes in dealing rooms. But as I said, it was really exciting. And the other thing, you also get a sense of risk, and you get a sense of what drives market inefficiencies. Because when you're seeing senior people around you that are being impacted by markets, where emotions are taking over decision makings, you really get ingrained into you at that young age. Hey, there's no way in the world you can believe in market efficiency when we see this behavior.
So you saw that what is commonly termed as the animal instincts pretty early on?
Yeah. Animal spirits are always there, right? And we will always be, I guess, suffer from the foibles of human nature. We get fearful, we get greedy, and we suffer from all those irrational afflictions.
Yeah. So I think UniSuper is characterized by doing a lot of things in-house and being very active, and also having acquired the ability to put trades in fairly quickly. But that wasn't always the case. Can you tell us a little bit about how the board got comfortable with moving to that model where you're more hands-on?
Well, when I joined 11 years ago now, and I joined very much with a mandate to bring our funds in-house. And I'm quite often asked, how do you get started? How did UniSuper manage to do these, to get their in-house strategies in place so quickly? And my answer is always, you've got to have strong sponsorship at the board level, because without that, you're fighting a battle that you're probably going to lose in the end. Because as soon as something goes wrong, you'll have a problem progressing. I was very fortunate. I had a key sponsor in Chris Cuff. Chris and I have got a really long association both in a business context and as friends. So there was a lot of trust there. And Chris was obviously a very influential person on the board. So I was really fortunate to have that sponsor. And then, I also very fortunate that we had an investment committee that was very experienced. They investment backgrounds themselves. So we're clear in terms of what was the board's responsibilities, the investment committee's responsibilities, and the management. Once we stayed within boundaries stipulated by the board and investment committee, we were pretty much allowed to get on with it.
Yeah. Was there sort of an example, a model that you followed, maybe from overseas?
I don't call it, not really a model. People ask me what was the vision, and I'm quick to say we didn't actually have one. Visions, are sometimes good, sometimes work against you, because visions can be pretty scary things when you're embarking on a path that some would consider really risky. You're changing business models. UniSuper was a successful fund, right? So it wasn't a turnaround story. So why go down this path? So a vision was potentially going to be dangerous. So we employed a phrase that I actually stole from someone else. Michael Chaney was the ex-boss of Westfarms, and he used to use this term called logical incrementalism.
Right.
I actually mentioned to Michael one day, I've stolen this from you. He said, "Don't worry, mate, I stole it from someone else." But anyway, so what's logical incrementalism? That is really, we're just doing things in a logical way, right, step by step. And so if we do fail at any given point, we're not going to fall too far.
Yeah.
And that way you bring the board along with you. You bring the investment committee along with you. So we started off literally by, it wasn't a big bang theory. We started off literally by implementing a listed property securities portfolio. Was it about 25 stocks, Bloomberg, end to end. And we basically said, look, this is going to be the first portfolio. Not much downside here. We'll run it pretty much on a passive basis. If things don't blow up, we might try something a little bit more ambitious. And that's pretty much how we got onto the journey. And now, if you think about if from day one, I said to the board, look, within 3 years' time or 5 years' time, we're going to do billions of dollars of zero cost collars on currencies, I reckon you'd have a few people on the board really worried.
Yeah.
So, but that's ended up where we got to, right, in a reasonably short order. But there was never really a leap to that. When it was time to do something like that, the investment committee said, yeah, that makes sense.
Yeah. So it seems that a lot of funds, they start with Australian equities, probably because they're most comfortable in that space. But you started with listed property. Why was that?
It was really just to make sure that the processes, the systems, etc., worked. In pretty short order, it was probably within 3 months we had an Aussie equity portfolio up and running too.
Right. So what are some of the learnings from those early days? Were there any surprises when you set it up?
No surprises. I think, look, the learnings, the logical incrementalism to me is, the best way to approach these types of, these are business transitions. It's not just a project, right? With a project, you can get everything has to be done on one day. I think, being pretty clear what you wanted to achieve in 6 months or 12 months, but don't put a sort of a line in the sand saying this is where we have to be in 3 years' time, right? Because things change.
Yeah.
And if the facts change, your opinion has to change. So we embarked on that path. We had some very clear parameters in terms of what we were going to manage in-house and what we were not. And we were not going to start taking on things where we were clearly not going to have any competitive edge. Right, so we're very disciplined in terms of the types of strategies. We looked at technology mandates, high yield mandates, Asian mandates, Japanese mandates, Indian mandates. We were never going to be able to get the team to manage those sort of strategies. So it was always going to be a hybrid model. Systems. If you ask every asset management team, they all want their own system. A fixed interest guys will want, let's say a Charles River, and equities guys want, IRS or whatever. And we said, look, we don't want to be a tech shop. We're an investment manager. So we're going to get Bloomberg, and it's going to be end-to-end Bloomberg. And that was a terrific decision because, we've got pretty much almost zero operational errors. Right?
Yep.
It's an integrated system. So these are sort of the key learnings.
Yeah. Can you give us a sense of how big the in-house program is at the moment?
It's about 70%. So we're over 100 billion. So around 70% of that is in-house.
And so pretty much every asset class?
Yeah, but once again, it's not those. We're still not involved in, particularly the offshore stuff that requires large teams of fundamental analysts, etc. We're not going to get in that. But all the generic asset classes, yes, we're across all of them.
So we always like to ask people, what is your best and what is your worst trade, and what do you learn from it? Can you give us a sense of that?
Yeah, look, we've look the ones I guess if from a thematic perspective, we were very early on to the tech theme, right? So post GFC, when I think the bulk of institutions were still a little bit gun shy when it came to taking on risk. We got on really early to the tech theme, to the point where we were going to the US and we were looking at pure tech managers, and they were dusting off their flip charts because nobody really wanted to talk to them. And so that was and since then we've only added to that exposure. We've taken some minor profits here and there, but then looked to get back in at any correction. So we've added that, and it's paid off really handsomely. In terms of, if I had to single out the ones, that's a thematic sort of trade, one specific or idiosyncratic trade. The one that probably the cleverest one we've done was a really big portfolio insurance position that we established in 2019. Now, this is applied to our defined benefit fund. It was, the face value of it was $9.6 billion, right? Which is by far the largest, single trade. Single position that I've been associated with in derivatives. And you can imagine now, they were way out of the money options that we bought at around 1%. During the depths of COVID, you can imagine the mark to market on that position.
Yeah.
It was, in the billions. Now, as it turns out, we're really proud of that, but we didn't make any money. We didn't cash it in, all right? And you say, well, why didn't you cash that in? Well, it's easy in hindsight, right? But it'd be akin to cashing in your insurance policy when the fire's across the road from your house, right? You wouldn't do it. What it did give us, it gave us the confidence to tell members they can rest easy, right? The defined benefit fund was in surplus, right? And it was protected with this options position. And it actually gave us the confidence to buy more risk assets at the bottom of the market, right? So that was, probably the cleverest trade we've done since my time at UniSuper. Now, there's been a couple of poor ones as well, right? If we look at our Chinese exposure at the moment, that's just not working out well at all, right? We've had a little flutter in UK banks. We got in. We got in high, we sold low, and I don't even want to look at it now because they probably rallied and they've made a fool of me. So we've got regrets over that. But I must say we haven't done anything enough that's big enough to actually hurt us, which is not bad. But yeah, we've made mistakes along the way. They just haven't been overly painful. The other, I guess, is the opportunities that you haven't taken advantage of. Right, that is always something that you've got regrets, about. I think the biggest one is probably, we as a team, 2 years ago or 2.5 years ago said decarbonisation is going to be, one of the most pervasive theme for the next decade. So we all agreed to that, and we did things around the edges. Portfolio, we've got a global environmental opportunities portfolio that is absolutely shooting the lights out, but I still think we could have done more. We could have really loaded up on not just tech, but green tech. When valuations looked expensive, but it turns out they were really cheap. So I think that's probably the biggest opportunity foregone, which gives you there's a regret factor there.
What do you define as your investment style? Do you tend towards more growth, more value, or is it something completely different?
I don't like the term, the style, right? I struggle with labels, right? But if you had to apply a label to UniSuper, it would be quality at a reasonable price, right? If you had to apply a label. And where does that derive from? It derives from a really basic first principle that we ascribe to, and that is superannuation equals life savings, right? So we've got some governing principles that we all live by in the investment team, and the first one is superannuation equals life savings. So from that, we want to have a quality bias throughout the portfolio. So if you're going to stick a label on us, that's the one that I'll be, most comfortable with.
Yeah. Now, in the years that you've built up a portfolio of in-house trades and deals, how has that sort of influenced your thinking about structuring mandates for external managers? Has that changed?
I think it has changed. I've got to cast my memory back a long time now, but when I initially joined UniSuper and we were pretty much outsourcing everything, I was sitting in on the meetings with external managers, and it was very clear that the conversation was all one way. The typical meeting would be the manager would pick their 2 or 3 favorite stocks and pretty much talk about them for an hour. And there'd be 5 minutes for questions, right? And on those stocks, which of course the manager would be all over, all right? So he or she would sound like a real genius, and you'd come away not really fully appreciating whether the manager's on top of everything. These days, the conversations are two-way. It really is. There's a huge level of mutual respect amongst the managers. They realise that we manage money, that we've got ideas and opinions, etc. The questions are much better. They're far more incisive. There's bluff-calling, or there's we just know when someone's not on top of things because we're managing money ourselves. And by the way, there's a structural point to be made too. We don't separate the external manager process from our in-house. Okay, they all sit in one team. Right? So you've got people managing portfolios that are also questioning the external managers.
Yeah.
There's a really good exchange of information, and we're very honest about that with the external managers as well. As a matter of fact, there are a couple of mandates that we haven't given, or they weren't actually up for it because they weren't comfortable sharing information with us. Right? And we understand that as well.
Yeah. So you want a higher level of information, and you probably also know better where to look for. But does it also change sort of, do you put additional clauses or protection within mandate contracts that you may have not thought about before?
It hasn't today. Clearly, what we have got is a fair bit of leverage over pricing.
Yep.
If you're negotiating with us, knowing that we do have in-house capability, the pencil's got to be pretty sharp, right? But that's also a function of size too, I guess. I imagine that most of the big institutional managers would negotiate pretty sharp prices. So I just think we do get a bit of an edge with our own in-house management. But in terms of the nature of, we've had tailored portfolios. There are some portfolios where we'll say, look, that here's a high yield mandate, for example, but we don't want you going anywhere near the energy sector.
Yeah.
Right. Rather than maybe a manager that's not as confident about making those sort of decisions and those sort of exclusions, we'll exclude that. If you look at our Chinese, we've got an Asian bond portfolio, and fortunately, we said no property developers. And this is before Evergrande, right? So
that was a good call.
Yeah. So they're the sort of things that that we have been able to tailor because of our, I guess, we're closer to the market than some of the other institutions.
Yeah. So over the years, sometimes fund managers try to be a bit more innovative, come up with new strategies. And I've seen a couple of cases where they sort of bring something out that potentially goes across multiple asset classes. And then usually quite quickly after that, you hear that there's actually only potentially 2 funds that might be willing to look at these strategies. That is you at UniSuper and probably Sam Cecilia at Host Plus, because I think you've made a choice to not be too rigid with asset class buckets. Can you tell me a little bit about that decision?
Yeah, I don't know if it's particularly innovative. I think it's more common sense than innovative. It's probably more counter innovative in the sense that, once again, it starts with the structure of the team. We've got and this sounds motherhood, and you've got to sort of be in it to believe it, but it's genuinely one team, right? So on any large deal, it's very common to see multiple asset classes being involved. When we, there'll be someone from the global equity team, the Aussie equity team, the fixed interest team, or the property team, etc. All in a room together, thrashing things out. So the starting point is that if there's a good investment to be had, we're going to find a home for it.
Yep.
That's the starting point. And obviously it has to align with our principles, etc. The best example I think I could give you is hybrids. If you look at, I doubt there'd be any other institutions that own more hybrids than we do. Three of the four major banks, when we had it wasn't the GFC, it was the European debt crisis when we had a huge blowout in credit markets, etc. You had the major banks issuing a lot of hybrids. 3 out of the 4, we cornerstone, allocating over $1 billion to hybrids. Now, what you'll find with a lot of other institutions, where do hybrids fit?
Yep.
They're not really equity, they're not really debt, there's something in between. It didn't matter to us. To us, they were a fantastic deal, fantastic value, and we were going to find a home for them regardless. So that, to me, is the real benefit of not being constrained with the so-called buckets.
Yeah. Now, you mentioned earlier Chinese equities, Asian bonds. Now, you were before the head of global asset management for Ping An. It's, of course, one of the largest Chinese insurance companies, which I think, gives you probably more of an insight on the Chinese market and the thinking of investors there than anyone else in Australia. And at the moment, we see that especially Chinese bonds are being included in major indices. Chinese equities has been included in emerging market indexes. So we see people thinking more about a dedicated China exposure, whether it's bonds or equities. With sort of your background at Ping An, what is your thinking around including more direct exposure to China?
Well, I would have answered this question differently maybe a year ago than I'm answering it today. But firstly, in terms of my background, I wouldn't attach too much importance to that, because all it means is that I'm more qualified than the average person to say, I know what I don't know, which is a hell of a lot, right? So that's the most important thing. But look, we do still have a dedicated Chinese exposure. It's not enough to hurt us either way. The last 3 months, the events in China have really, really testing our conviction.
Yep.
And it's not Evergrande. And as a matter of fact, Evergrande, I think there's a real positive to be taken out of Evergrande. Evergrande is a sign that the Chinese are more inclined to let excesses work themselves out, let the system clear, right? It's failure is important.
Yep.
For a properly functioning economy, right? It's important that we see over-leveraged, players fail now and again, as long as that you don't it doesn't develop into a Lehman's type of situation, which I don't believe it will. China, so it's not Evergrande at all. As I said, I think there's a positive to be taken out of Evergrande. What's much more concerning is what's happening with the education sector, the tech sector, etc. So I think the positive perspective on that is, look, this is just the Chinese saying, look, if you are owning assets and those assets are deemed to be social infrastructure, right? We're not going to let you just be the profit motive is going to rule everything. It's social infrastructure, so we are really going to put on a tight leash. And if in the education sector, I mean that. I've sort of inferred that to me, you're not going to make any money, right?
Right.
Now, if a sector can't make any money, while it might have public utility, to an extent, an offshore investor is worth zero.
Yep.
So the question is this reset that we're seeing in China going to be restricted to tech and education and, maybe some healthcare, et cetera, where we've got social infrastructure, or is this signaling, a much, much broader reset where, this whole China as a state-based market economy is actually now being threatened. If that's the case, right? Well, China as an investable proposition becomes a much, much bigger gamble, right?
Yeah.
So it's fair to say that our conviction has diminished quite a lot.
So you think there is a real chance that they might move away from a more capitalist system?
That's the signals that are being sent at the moment, right?
Yep.
That's so I said tread warily and look. Hopefully in 3 years' time we're looking back and saying, "Hey, what a great buying opportunity that was."
Yeah.
It was just China's resetting in a couple of sectors, but Xi Jinping hasn't come out and made any effort to really calm market fears the way I've seen it.
No. Do you also worry about sort of the geopolitical picture where the trade tensions and then now more tensions around Taiwan are flaring up?
Look, if China invades Taiwan, all bets are off. Okay. There'll be nowhere to hide. But let's say that is, I'd like to think that's a highly improbable event. You can't structure a portfolio based on that, on that being a base case, or even, attaching any sort of decent probability to it, because you'll have your cash under your mattress, or, but geopolitical tension, there's always geopolitical tensions. And I think the impact on investments and on portfolios is generally been exaggerated. Right? If you look at, you track back geopolitical shocks, and if you exclude the Arab-Israeli war, and the impact on oil price, the oil price shocks, etc. Now that had a fairly long and severe impact. Most other geopolitical crises, if you actually track them back and you look at markets, 12 months on from when the point they started, you've pretty much made money most of the time.
Yeah.
All right. So I think they're exaggerated as a major source of risk.
Yeah. Yeah. Fair enough. If we talk a little bit about asset allocation, I think one of the key problems that investors are trying to solve today is the low bond yields and the fact that bonds probably have lost some of their defensive qualities at the current interest rates. Now, we've seen several ways of dealing with that. I think a lot of funds are looking at sort of bond proxies in real asset properties. What is your solution to this problem?
Yeah, well, the first solution is that people, investors do have to recalibrate what their expected returns are. Right, so that's the first thing everyone has to do. And we've seen that. If you look at the target returns of most funds around the country, the growth options, etc., they've gradually reduced target returns across the board. In not totally commensurate with the reduction in bond yields, but they've all been on a downward trajectory, and largely driven by falls in the risk-free rate. But if we talk about bonds as a defensive asset and replacing them, we've got to firstly, what are those defensive qualities that we're looking for there? Well, the first thing is you need liquidity in a crisis. All right, so unlisted assets don't help you there.
Yeah.
So to me, what we're doing is keeping duration pretty short, and we're holding a lot higher cash levels than we would have otherwise had, because you're right, with rates so low, the volatility of your bond prices are going to be high, right? Just the mathematics of it all. So we're tending to hold a lot more cash than we did in the past. Yes, if you want to reduce volatility, unlisted assets are a way, and we are looking at gradually increasing unlisted assets. But even in the listed space, if you're not overly concerned about short-term volatility, you can still buy defensive assets in the listed space, right? So if your focus is more about guarding against a permanent loss of capital, well, there are listed companies that are going to experience volatility, but you can guard against a permanent loss of capital.
So UniSuper still has a large defined benefit division as well. I think it's about a third of the overall fund. Do you deal differently in that section with these type of questions?
Yeah, look, at defined benefit, it's very much an absolute return focus. It's all about meeting the promises. So you are more in that liability-driven framework. Having said that, our bias towards quality assets is still the same. We don't have the same need for liquidity, right? Because if you find benefit, you're in. So we can take a longer term view with our defined benefit portfolio.
Yeah, we've seen a lot of changes. Well, it seems that the super industry is always changing here in Australia, but more recently there's been a bit more scrutiny on performance versus the asset allocation with the Your Future, Your Super reforms and now the performance tests at APRA. Now, I looked up the most recent heat map, and UniSuper is looking pretty good on that one. I think over the 5-year, the relative performance versus the simple reference portfolio think you guys are number one, so you don't have to worry.
Just leave it at that then, right?
Okay, we'll leave it at
Yes.
Yeah. But how do you think about these sort of metrics? Because there has been a lot of criticism around the fact that, well, this basically doesn't take into account the risk and return trade-off. It's purely looking at an asset allocation and how close you are to that. What is your view? Is this a good test? Is this a bad test? Is it reasonable?
Look, firstly, everyone agrees that high cost, perennially underperforming funds should be closed down. All right, so that's the starting point, and we all agree with that. The question is whether this is the right way to go about it with these sort of tests. And look, just because we happen to be looking pretty good at the moment doesn't mean that they're the right tests, right? We've got to come back to the principles. There was a good, a really concise paper, I think it was written by Frontier, showing how there are some funds there that have consistently outperformed their peers that are failing the test, and vice versa.
Yes.
Underperforming funds that pass the test. When you are getting results like that, there's something fundamentally wrong with the test.
Yeah.
Without even having to go into the details of the benchmarks, etc. When it's spitting out results like that, you've got to go back and say, why is it spitting out the results? There's something wrong with the test. Now, personally, I felt that APRA was well and truly on the right track with the heat map anyway, right? And, just a simple sort of look at that heat map and you could have come up with some sort of simple rule whereby, over a 7-8 year period, if you never found yourself in the second quartile over any given year, well, you got a case to answer. Why should you still be allowed to run this fund? I think something as simple as that would have sufficed, quite frankly. And APRA will argue, well, the heat map's still there. You go to the ATO, but before you go to that, you have to write a letter to your members, a self-incriminating letter to your members saying you're in a dud fund. Yeah. So by the time you get into the ATO website, the horse is bolted.
Yeah.
So I wouldn't be surprised to see, let's just say, a review of these tests in a couple of years. You can imagine next year when we've got, another, 700 different products being benchmarked, et cetera. There's probably going to be, there's going to be a lot of letters being sent out, I'd imagine. Right?
Yeah, and there's also a little thing about past performance not being an indicator of future performance.
Well, that's right. Yeah,
which I think was pointed out by Frontier indeed as well. That you look at Maritime Super, they didn't do so well in the test, but they've made changes and they've now basically a completely different product. Yet they still likely to need to write a letter to their members.
Yeah,
based on the last 7 years.
They're really flawed. If you look at the span of investment products, and if you look at, say, a high growth option with 100% invested in growth assets, I actually see the test as being valid, right? It's all growth, right? And if a member is elected, 100% growth, I think a member's got a right to feel that you're doing better than an index portfolio. I think that's a fairly reasonable thing to expect, right? But you look at the other end of the spectrum, right? Look at a conservative option, right, where you've got 70% in defensive assets, 30% in growth, right? There, a member has actually said, look, I want you to, rather than it's all about growing my capital, I actually want you to think about capital preservation here. I've got a nice pot of money here, right? And, I'm pretty concerned about preserving that. Now, the way we look at that type of strategy, it's benchmark unaware, right? You're putting assets there which are not going to sustain a permanent loss of capital, maybe lower volatility, et cetera. You don't care what the benchmark's doing.
Yeah.
Right? And I think that's where the tests are really struggling.
Yeah, absolutely. So I think part of the philosophy behind the test as well is that there is this push for consolidation in the industry. And there's been sort of a number thrown around that funds should be at least $30 billion in size to, have the right scale and the right sort of ability to drive cost efficiencies. Now, at 100 billion, you don't really have to worry about that. But what is your view on mergers? Is UniSuper in the market?
Yeah, look, just in terms of, I don't know where the 30 billion came from, right? I don't know if there's anything magical about that number or any science behind that number. And I'd imagine that there are $20 billion funds that you can run more efficiently than some $100 billion funds are run. But let's just accept the premise that, if you've got the right technology in place, scale should lead to cost, to economies. And let's just take that as a given. Is UniSuper interested in growing? Absolutely. So recently we announced that we're now open to the public.
Yeah.
So we basically, now formally said that we are looking to source growth in AUM outside the tertiary education sector. As an aside, in a couple of months, we've raised over $600 million, which, given that, if you wouldn't have seen a UniSuper ad, because we haven't had any, right? So that's pretty much word of mouth. So, it's a great story that's never really been told. And just from word of mouth, we've been able to attract that level of inflow. It's been fantastic. So yes, we are looking to grow the fund outside the tertiary education sector. Yes, if a merger makes sense, we'd be absolutely open to it. But the first, second, and third test that it has to pass, it has to make sense for our members.
Yeah.
And it's not, sure, for the members of the fund that we're merging with, of course, and they've got their own trustee board to think about that, but it has to make sense for our members.
Yeah.
We've got this concept of the sweet spot. What's the sort of sweet spot that we want to strive to get fund flows and scale so that we optimize our investment outcomes and our cost outcomes. And that's a test that we will look to pass so that we can justify any merger with our members.
Yeah. So I think it was in July that UniSuper announced that it was open to all members. But I think that structure was in place for some time before that. What was sort of the decision process behind becoming a public offer?
There's a few headwinds, right? Firstly, the education sector itself is under a lot of pressure, right, because of COVID. You've seen borders shut. So when you've got 40% of your foreign students are Chinese, and foreign students constitute a fair bit, you've got to think about where the growth of that sector, the outlook for the growth of that sector. That's the first thing. But then clearly, the choice and stapling were game changers.
Yeah,
right? They were absolute game changers, and so it was a pretty easy decision in the end.
I think that's coming into effect on the 1st of November, the stapling rules. So how is that going to change the sector, you think, and what's sort of the impact on UniSuper?
Look, well, if we get the story out there, we should do pretty well, right? We've got a pretty compelling story to tell. High performing, we're one of the lowest cost, highest performers in the market. We've got a great story to tell. We've got some unique products, and global environmental opportunities, for example, in-house managed, etc. So we've got a really good story to tell. So we've got every right to look forward to the challenge.
Fair enough. If we look a little bit towards the future, what is sort of on your agenda in the coming months?
First thing is getting everyone back to the office. That's what I'm really looking forward to, first and foremost. And it's a serious thing. I'm a firm believer that there's no such thing as a Zoom or a Teams culture. You don't build real culture, collaborative culture over websites and virtual meetings. What does the new normal look like for us? We agreed as a team that everyone's going to be in the office Tuesday, Wednesdays, Thursdays. When we were doing that just before the latest lockdown, the energy in the office was, palpable.
Yeah,
you could just feel the energy. We're all, pretty tight-knit group. There's only there's less than 60 of us all sitting on the same floor in Bourke Street in Melbourne, and we want to rebuild the social capital that's been eroded, over the last few months. We've hired a few people, senior people. We have to integrate them culturally into the team. So that's a really big priority for us. The second thing, of course, is public offer, and that puts there's different demands on the investment team. When you've gone through your lives not really having to promote yourselves, it's a different. It creates its own challenges. My team is aware that they've got to get out more and help tell the story. So that's going to be another challenge. And then look, the other one is really business as usual. It's not. I think it's very dangerous trying to predict things. But it's really important to sense and respond really quickly.
Yeah. So do you think that you switch to a model where you do maybe 3 days in the office and 2 days from home and give a little bit more flexibility, but still have that ability to build culture? But
the important thing is that it's not a case of is 3 days, any 3 days. I mean, it's important that we're all in there the same 3 days. Otherwise, you've got the worst of both worlds.
Yeah.
So we've got to try and and there's been some fantastic, some eye openers for me over the virtual meetings. We've the information sharing. The whole team gets to sit in our investment committee meetings.
Yeah,
can't do that physically. Little things like that that has changed, and we're going to hold on to the best parts of that. But there's no substitute for everyone being in the office at the same time as well.
No, for sure. Does it change your view on how you do transactions as well? And I did an interview recently with one of the guys from BlackRock, and he said, when I asked him about the changes in the pandemic, he said, well, if you told me 18 months ago that I would buy a company without having visited and without having had a face-to-face a meeting, I would tell you were crazy, but we've just done one. And it doesn't mean that he's going to do a lot of them, but he said, yeah, there are changes and we can make things slightly different and probably end up with a hybrid model as well. But from sort of that transactional point of view, has it changed things?
Well, what has changed is that we know that we can do it.
Yeah.
The question is, do we want to do it? Is that the preferred way of doing it? I would still argue it's not the preferred way of doing it, but we know that we can resort to that in a crisis. We can do it. Having said that, what if the next crisis is a cyber crisis?
Yeah.
Guess what? How are we going to deal with that? Everyone's going to have to get into the office.
And we have to camp out in the office.
Yeah, that's right.
Excellent. Well, John, thank you very much for your time. You've been very generous with your time. It was a great conversation. So thanks for doing this.
A pleasure.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.